Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Here on this Wednesday afternoon, the market's closed, as you can see from the screen. Pretty green, up about 178 points on the Dow Jones. Transports are up, utilities, just go on down the list there. But and as you can see from the right, the utility is still the strongest for the year, up 11% for the year for the utility average. That's an area I'm still bullish on. I think really for those that want to participate in the market, don't want to miss out on gains, want some income, I think it makes a lot of sense right now. It's a necessity. It's things that people have to have in this tough economy. So I still like the utilities, whether they're individual names or as a basket. Still think that's an area, and it is still the strongest area when you look at the major sectors, kind of as far as momentum. But we have had just a whole slew of news the last several days. Of course, we had the MF Global bankruptcy, and that's probably going to go down as maybe the 8th largest bankruptcy in U.S. history. You know, Lehman Brothers was, of course, the biggest in '08. Washington Mutual was in '08. There's been a whole slew of them, but MF Global is probably going to go down. I say probably because it's hard to determine exactly the number right now. It's estimated at about $41 billion. Now, just in comparison, Lehman Brothers was almost $700 billion, huge. But still, a large bankruptcy. It is bigger than PG&E back in 2001. Chrysler is bigger than Chrysler. So you do have a big bankruptcy going on right now, and that's something that all of this is starting to remind me kind of 2008, right? You know, you have bailout. Of course, we have Dexia over in Belgium, got bailed out a few weeks ago, kind of around the turn when the market started to turn for the positive. And then you have this bankruptcy right now in the form of MF Global. I think it'll probably be a bankruptcy that the average American has never heard of. They don't know what MF Global is. They knew what Chrysler was. They'd heard of General Motors, WorldCom, Lehman Brothers. But for them, MF Global, they don't really know what that is, the average American, I wouldn't say. But it is a big financial company, and the problem here is not only are they declaring bankruptcy because they made some big bets on Europe, and their CEO, John Corzine, used to be the head of Goldman Sachs. Then he was the New Jersey governor, got in a real bad car accident, almost died, and then last year took over at MF Global and made some big bets on Europe and basically bought bonds and other things that he thought would appreciate in value. The problem that they're running into, it looks like, is potentially they filed bankruptcy. They had been audited. After they were audited, there's talks that they went in and used clients' money to, I guess, double down on some of these trades. So if that's the case, this isn't just a run-of-the-mill bankruptcy. You could see some criminal stuff going on, civil lawsuits, whatever the case. So that's kind of nasty. I had a damper on the markets on Friday, Monday, and then on top of that, you get some weak Chinese manufacturing data. You get some weak U.S. manufacturing data, and you had the referendum in Greece. So they come out with this big package, right, to basically take the Greek bonds down to about 50 cents on the dollar. Maybe China would contribute to put some money into this deal, and Germany and France, and they would recapitalize some of the banks, and we'd all move on, and the market celebrated with great joy. And yet, what everybody seemed to forget was the fact that this wasn't a done deal, number one. Their credibility is diminished. All the European leaders' credibility is diminished. And so when they go and announce this potential package or this deal, it's not a done deal. Then you have Greece, who's going to take a haircut in this thing, right? Well, Greece comes out, and their prime minister says, you know what? We're going to go ahead and do a referendum on this. First one since 1974. He's doing that for political gain. And the problem is that delays any financial rescue package. So there's pressure on him to either not do the referendum or push up the vote, in the next couple of weeks. So we'll see. The bottom line is that what was a gift to the market a few days ago then became a curse, and everybody said, oh no, what happens if this vote takes too long or doesn't go through or whatever the case, and the stock market sold off. And it sold off in rather dramatic fashion in the last few days, about 500 points. But the key was we were overbought, right? We were overbought, and then we came back in and we essentially gave up a third of the gains from the bottom. If you look at the S&P here, this is the trading box that we've been talking about for what seems like months, and it has been months. It's been since August. We've been in that trading box. We went below it right in here, and then, of course, we came out of it and went up to the upside. And I wrote a blog basically saying, be careful of the fake out breakout, because here, if you got short, then it reversed quickly. Here, you may want to get short up here and get long up here as it breaks out, only to see it reverse, and that's what we've seen so far. But I will say that it's setting up nicely, potentially, for a trade, and the reason why is you can see we broke out of the box, came back into it. It was about a 38% retracement, one of the Fibonacci retracements, so we gave about a third of it back, the gain. And then we had an up day today. And I know a lot of you, from talking to, are very frustrating trading this market because you're getting whipsawed. You're shorting at the bottom. You're going long at the top. You buy one day, you see it go down the next day. You don't do anything, the market rallies. And there's bad news in the market rallies. I have been keeping my trading very small, not only in the number of trades I'm doing, but the quantity involved as well, because the whipsaw risk is so high right now, right? It's based on the news, and the news changes every single day, it seems like. One day it's great, and the next day it's horrible, and the market rallies and it sells off, and that's just a recipe for disaster. So the way I'm playing is continue to hold a reasonable amount of cash, owning things that aren't as volatile as the market, picking off a few trades here and there. We talked about Citrix, CTXS. We did that trade in our aggressive strategy. As it was turning the corner here, this was the entry point because it turned the corner, went above its 50-day moving average. Love this type of chart setup. Had a rally, kind of flatlined a little bit, came off earnings that blew away, and of course they do the online GoToMeeting, and people that don't want to travel can do meetings online now, and you can see their screen and see video. So I was highly confident that the earnings would come in better. They did. The stock, not only had it gone up from here, but it went up another 18% that day. And intraday, I went ahead and locked in gains on it because that's what this market's about, right? You make the money, and look what's happened since. The stock was around $78, came all the way down to $70 yesterday, up a couple percent today. Maybe now's a good entry point if you're looking at it from a more fundamental standpoint. I didn't buy it for fundamental reasons. I was rewarded because I bought a good fundamental company at a time when the chart set up. But this is a stock that is an example of the trades that you should be doing in this market right now. And again, I've been trading very lightly because the people that got overly bullish 2 days ago got slaughtered the last 2 days. And I could sleep at night because I had so much cash and non-volatile positions. Now, today I did put on a trade, again, for a shorter-term trade on U.S. Steel. And very tied to the economy, very materials-oriented. So this is a stock that is going to be like the end of the tail on the dog, right? The stock market goes up a lot. This is going to move quite a bit. You can see it was up 6% today. They recently came off earnings. I like, again, the chart set up. Turning the corner looks very much like the CTXS, the Citrix Systems we did. But, you put a stop in fairly tight, maybe 4, 5, 6%. And you put that stop in there. If the trade doesn't work out, you got a low risk. If it works out, you've got a lot of upside, I think. And so those are the types of trades I think look good right now. And there's a lot of them that look like that. There's a lot of stocks that have turned the corner. They raced up, and in the last few days they've come back down to 50-day moving averages, things like that. And so they're giving you an entry point. I think those types of trades make sense right here. But overall, we've had a lot of really negative news lately, haven't we? I mean, if you think about it, we've had either big financial problems or potential bankruptcy rumors from the likes of Eastman Kodak, American Airlines, AMR, Morgan Stanley even, and then recently MF Global. And MF Global is legit because they actually did go bankrupt. So you're starting to see this type of stuff. You're seeing more intervention, which is a negative. And again, the market seems to celebrate intervention. And so as opposed to you and I, who may be fundamentally opposed to more Fed intervention, more intervention in Europe, they're doing it, and the market is celebrating it. Will it last? I have no idea. All we can do is participate and be cautious. That's the key. We don't want to sit there and not make money. The goal is to make money, even if we disagree with what's going on. You know, a lot of people disagreed with the whole tech bubble in the late 90s and made no money during that time. And then, of course, they capitulated at some point and jumped in late 1999 only to get slaughtered. But the key is that you have to acknowledge the prices, what they're doing, respect the prices, participate, have some specific stops, some specific ideas of where you would get in, where you would get out, and don't go overboard. This is not a runaway bull market. I hope it turns into one, but there are several reasons why this is probably going to be a choppy, sideways, hard market. And if I had to say, are the odds better we go down than up, I would say, yeah, they're greater than 50% we go down, because the economy is still really tough. In fact, one of the things the Federal Reserve referenced today, remember the Ben Bernanke, they had a FOMC meeting, of course left rates unchanged, but what they stated was, we're downgrading our growth forecast, and of course their forecasting has been awful, but they downgraded it, and when they downgraded it, that sounds negative, so you thought, okay, well they're going to come in with more QE3. But then they said, you know what, though? We see positive, and this was a change in language. The consumer spending was a little better than last time, or we're seeing more consumer spending. And I look at that, and initially you go, that's good news, right? Well, the market may take that as bad news, because if things are getting better in the Fed's opinion, they're not going to do QE3. Well, let's think about this, though. Consumer spending is up. Consumer income keeps going down. So the gap from what people are making and what they're spending continues to shrink. Why? Because they're spending that money on utilities. Ooh, coincidentally, it's the best sector this year. Food, but the Fed says we have no inflation. They says we have 2% inflation. You go to the grocery store, I mean, look, if you look at inflation and look at how they used to calculate it back in the 80s, inflation's running about 11% right now. But you just change a few formulas, move some numbers around, and eventually you can come to a 2% number, I guess, and that's what the Fed's doing. But people are spending more on healthcare, food, and utilities. And so, yeah, GDP comes out okay, and consumer spending looks okay because they're spending more on stuff they have to have. So what we do is we go invest in that, but we don't say, hey, things are better because of consumer spending. They're not spending on a bunch of stuff that they really want. That's not happening right now. But if we look at this market, we say, you know, the good thing about this market is we are seeing a rally where we went up, then we came down, and potentially we bounce off of the old, you know, kind of breakout here. And you try to be exact. It'd be nice if we didn't come back in the box. But the point is that we're in this box, we bounced off it, came back down, and then we rally back. That's what you want to. That's the setup you want. I mean, look, for all those people that didn't participate in this rally, they're saying, hey, I'm getting a second chance. I'm not overly bullish on a lot of things, but I am going to acknowledge the fact that the market could rally through the end of the year for several reasons, right? Just hedge funds chasing, whatever the reason might be. And so let's ride that. But let's not be fooled to think that in the last 30 days, everything has changed and gotten much better. As I've said before, I want things to get better, but it has to prove it to me, right? We need to see all these numbers improve. We need to see the Fed quit printing money, Europe quit trying to fix everything, and I just don't think in the last 30 days things have changed that much. You know, the world was going to end here, and up here everything's fine. I don't think it's either one of those. I think the world is very tough. There's a lot of challenges. I think the risks are to the downside. But that doesn't necessarily mean that stocks should be going down 50%, and I don't think they should be running up 10% in a month like they did. And so now what you're getting is adjustment. But look, the earnings have come in. The 70% of the companies have beat earnings estimates. Qualcomm's coming in after the bell today, beating estimates. Technology's doing well. And stocks aren't crazy expensive, but again, right now what it's about is Europe. And when you see what's happening is that if things in Europe go okay, the market celebrates it and runs up. If things in Europe don't go, the whole market goes down. So that correlation of one is still there. Okay, now this is a picture I drew just a few days ago, and the thing that I that I started realizing when I said this kind of reminded me of 2008 when Dexia, which was this Belgian financial institution, received this bailout package. I think it was 4 billion euros. The market, just about that time, it already started running up a little bit, but just about that time, we started this nice little run. And I started to think back of 2008. Lo and behold, I was looking back at some of the rallies we had. You remember back in here, Bear Stearns was essentially bailed out by J.P. Morgan. But it wasn't just J.P. Morgan. The Fed gave J.P. Morgan a loan to go buy Bear Stearns. So basically, Bear Stearns had to be bailed out. The stock market ran. About 14% it ran up. And then after that, though, we had a nasty, nasty decline. So the point is, just because these companies are getting bailed out and we have this temporary celebration, we can enjoy it. We can participate. Let's hope it goes up to 2,000 on the S&P. But we have history as a guide to say, just because companies get bailed out, that doesn't solve all the problems. Could this fall down like this? It could. And that's what we need to prepare for. And I think, looking at this picture, again, Bear Stearns was bailed out. Everybody thought that's the key to not letting this thing spiral down. And all it did was postpone the stock market falling for a few weeks. And it actually could have made things worse. And, look at MF Global. MF Global files bankruptcy. The stock market goes down, and then it goes up 180 points today. So, not a major deal right now. It's more about this European situation. That's really what the stock market's trading off of. But in general right now, I am simply saying I'm doing some trades, but I am not going to rush in there and go chase markets. But if you've been wanting to buy and you're underinvested, this is key. You're underinvested and you want to buy some things, I think now's not a bad time because we had the pullback. We had a pretty nasty pullback in 2 days. And so you got a decent entry point. But if you say, hey, I'm skeptical, I want to participate, but how do I do it? Go in there, put some stop losses in there. That's the way to do it. And then if the market proves itself to us, great. But again, I don't think necessarily things are getting better. I just think from a technical standpoint, it's a trading opportunity right now. All right, guys, Google Plus. I'm plus Carl Eggers. Twitter.com/Carl Eggers. CarlEggers.com. Free subscription up at the top right. And keep the comments coming. And for those that have donated to the blog site, that's nice. Thank you very much. Appreciate you doing that. And then also EggersCapital.com for the money management website on that. Take care and have a great day.